The real beauty of ISAs is that they are simple. It's easy to understand. You've got a £20,000 allowance running in line with the tax year, and think of it like a blanket this account throws over your money to stop HMRC having a look and taking a slice of your returns. And for most of us, £20,000 is going to be more than sufficient to cover what we'd save in a year. But there are some situations where you might find yourself with more than that in one go. You might have inherited some money, you might have just suddenly sold a second property, or perhaps you've won some prize money, maybe a lottery, who knows. But if you do come into a chunk of money and you can't quickly get it under ISAs or pension, then you might have some money that you need to invest in what we might call a general account or sit in a bank account outside of an ISA. Increasingly, I'm also seeing people that have opened trading accounts, usually on a mobile app, and just haven't given thought to the ISA. They've been given an investment account, they've got off and running, started putting some money in there. Maybe they've had some wins with certain picks on investments, and it's led to values that are getting into reasonable numbers, but they've not sheltered it under their ISA account. In this video, we'll have a look at the 3 types of return that you can earn whilst growing your money, and I'll point out why the ISA allowance has become more important than ever. Hi, my name's Andrew. I am a chartered financial planner. If you're new to the channel and like this type of content, tap subscribe for plenty more to come. The reason that I say the ISA allowance has become more important than ever is not just because it saves you the tax on the returns on your money. The ISA has always done that. It's that more recently, we've started to see some cuts to the allowances, the tax allowances that relate to investing. And we've also seen some of the tax rates rise. So if you do have money sitting outside of ISAs, more and more people are going to be getting drawn into the pain of reporting income and gains to HMRC, or perhaps not reporting this out of sheer lack of awareness or otherwise, and that could potentially risk penalties, interest charges, or worse. If you've been employed your whole life, not self-employed, you're probably not needed to do any self-assessment. But more and more people are going to need to do that, or at least get on the phone to HMRC and report these income and gains, unless we really make use of the ISA allowances we have available to try and limit this. People with relatively small amounts invested could be getting caught up in this. So let's take a look at those 3 sources of returns and see whether it impacts you. We'll start with the one that people are most familiar with, and that is interest. Think of it as a deposit account, a bank or building society type account. You've put your money there and you've been quoted a rate of interest. At the time of recording, you're probably looking at about 3 to 5% a year in interest, and you'll know what it is going in. It might be fixed, it might have the possibility of changing in future, i.e. variable, but as you enter the account, the provider will tell you the AER, the rate of interest on the account, so you can work out what you're going to earn over that year. Now, interest payments can also apply when you're investing, so it's rare that people hold direct bonds lending to a company. It's more common that people hold funds that package up bonds, so a fixed interest or maybe even cash type investment, a money market fund perhaps. Some of these funds, they pay out in interest rather than a dividend. You can check this online, as I've shown here, but if you're receiving interest, then if it's outside of ISAs and it's taxable, that's what you'll be reporting and paying tax on rather than dividends or otherwise. Now, luckily, we've not seen too many changes on sheltering your interest. You will have your personal allowance of £12,500, and if you have earnings within about 12.5 to 17.5, keep in mind the starting rate band. But for most people, a lot of people earning over £17,500 a year from other sources, you'll want to be concerned with the personal savings allowance for interest. For basic rate taxpayers, that's £1,000, higher rate £500, and if you're additional rate, unfortunately, you don't get any personal savings allowance at all. Now, over and above this, you're going to be paying income tax on any interest you receive in a tax year, 20 or 40, 45% perhaps, rates of tax on that interest. So let's say that you're getting 4% interest on your savings outside of ISAs. Well, that means that a basic rate taxpayer really only needs £25,000 and more to start paying tax on their interest. For a higher rate taxpayer, that comes down to £12,500. An additional rate are going to pay from the first pound of interest. HMRC are fed information about interest from banks and building societies, so even if you're not doing self-assessment and you're employed, you might find that your PAYE tax code changes because HMRC are aware of interest payments. You could see how this could quickly go wrong, particularly if you've got lots of sources of interest, if your income's changing quite regularly. So for some, it might make sense to actually enter self-assessment and just pay the tax that you're due on your interest after the tax year is finished. But if you can avoid this by sheltering with your cash ISA or stocks and shares ISA if you're investing, clearly it'd be worth doing. So now let's move on to dividends. You might receive dividends if you are the owner of a company. If you own shares in a company and that company makes profit, the management team there can choose to pay out some of that profit to you as a dividend. Now, what typically happens when people are investing is that they own a basket of companies within a fund. The fund manager collates all of the dividends in from the various companies you own, and then they'll pay that out in one distribution to you as the holder of units in that fund. It might be paid annually or maybe more frequently, perhaps even monthly. But when you receive this dividend, you are potentially liable to tax on it if it sits outside of ISAs or pension. Importantly, you don't need to have drawn this dividend out or received it in cash in your hands. Even if you have accumulation units which just automatically reinvest the dividend within the fund so that you never actually see it on your transaction statement, you are still potentially liable for tax on that dividend. So at the end of the tax year, you need to look at the dividends you've received from all of your investments and total those up. If you receive dividends on money outside of ISAs, you then need to look at your allowances to see whether you've got tax to pay if you've breached. You can use your personal allowance, but again, many people are going to be over 12,500-ish pounds a year. So you then need to look at your dividend allowance. It was brought in 2016-17 when they got rid of that notional tax credit, and it was £5,000. But as we stand now in the current tax year, it's been cut to £500 with no real plans to increase this. Pretty pitiful, right? What you perhaps want to check is the dividend yield on your fund or shareholding. You can find this online, but just bear in mind when you're looking at the dividend yield, this is the historic one. It's looking back over, and it will be variable. Dividends can change, they do. But typically, if you've got a basket of shares, the world's companies, you'll have 1 2%. And if you lean more towards UK shares, you might be getting into more 3 4%. To explain that dividend yield, let's say you've got £100,000 invested and a 2% dividend yield. That would be £2,000 a year in dividends. As I say, it will vary, so you're not going to pin this down to the exact pound. You need to check at the end of the tax year what dividends you've received. What it does mean is that for, let's say, a 4% yield on your investments, you only need roughly £12,500 invested or more outside of ISAs, and you're going to be drawn into paying tax on those dividends. Now, it might not be huge amounts of tax that you actually need to pay. I mean, £1,000 in dividends over the allowance for a basic rate taxpayer works out to about £87 of tax. Not huge amounts here, but it's more the pain of having to report this to HMRC. They say that if you're getting dividends below £10,000 a year, you can contact their helpline. Great, I'm sure that's a wonderful experience. Or if you want to do self assessment at any amount, but definitely dividends over £10,000, you can do that. Again, many people just might not be familiar with this, so it's the pain of getting drawn into it. If you can avoid this by sheltering your money within an ISA, you'd be well to do so. Our final source of potential returns is capital gains. So, in simple terms, if you buy a share and sell it in future for a higher price, that difference is the capital gain that you're realizing. Now, what happens with a fund that's a basket of shares is that over time, the unit price of that fund rises. You can exclude the dividends, but the capital gain, when you eventually sell units in that fund in future, you need to work out that capital gain, and that's what's potentially subject to tax if it's outside of ISA or pension. Now, those allowances for capital gains have been significantly cut, as shown here. And if you breach that allowance in a tax year, then you have to pay capital gains tax at the rates shown here, which again have been recently increased. So this is probably the most important one, where ISAs and maybe pension come in to shield your money. You don't just want to balloon money up over the years, invest it, grow it, and then when you come to actually withdrawing and selling those units, you're suddenly hit with a capital gains tax bill. So hopefully this video has helped highlight the importance of using your ISA allowances to help shield your money, hopefully prevent you from getting drawn into some of these annoying sort of returns and paying tax on smaller amounts. I mean, look at the dividend allowance, for example, going from £2,000 to £500, a £1,500 cut in the allowance. Well, most people are basic rate taxpayers, so they're going to pay, what, about £130 of tax if they had dividends at that rate? You're telling me HMRC really wants people on the phone just to pay £130 of tax? It's a pain. I really don't understand the reason for bringing us down to these daft and minuscule allowances. It's not so much the tax generation as much as it is the administration, the extra burden, the problem of people having to report these. That's what makes the ISA allowance so important. Use it where you can do. If you're a couple, you could be sheltering £40,000 a year between you each tax year. Make the most of those allowances. As always, thank you for watching. If it's been of some value, if you wouldn't mind tapping that like button, as it does help with the YouTube algorithm. If you're new here, don't forget to tap that subscribe button, and I hope to see you for a future video.